What it means to me is that if they create this currency backed by gold, Robert, this will be the largest transfer of wealth between nations we will ever see in the history of money.
The biggest transfer of wealth in human history is about to happen. That's a bold warning from Robert Kiyosaki, the author of Rich Dad, Poor Dad. While most fear market crashes, Kiyosaki sees them as massive opportunities for those who are prepared. In his recent interviews, he has emphasized that the coming economic downturn could create more millionaires than ever. But here's the catch. To succeed, you need to understand how wealth works during a crisis. Today, we're breaking down Kiyosaki's key insights on the market correction, why it's inevitable, and the strategies that could help you not just survive, but thrive. Stick with me. This could change everything for you. Before we dive into Kiyosaki's predictions and strategies, let's quickly establish why his perspective matters. Robert Kiyosaki is best known for his book, Rich Dad, Poor Dad, which has sold over 40 million copies worldwide. What makes Kiyosaki interesting isn't just his success as an author, but his track record of understanding economic cycles. Back in 2008, Kiyosaki predicted the housing crisis in his book, Rich Dad's Prophecy, published several years before the crash occurred. He's been consistently vocal about financial bubbles and the importance of financial education over traditional investment advice. What separates Kiyosaki from many financial commentators is his focus on how economic systems actually work, rather than just giving stock tips or investment advice. He emphasizes understanding the difference between assets and liabilities, the impact of debt on the economy, and how monetary policy affects everyday people. However, it's important to note that while Kiyosaki has made some accurate predictions, not all of his forecasts have materialized. Like any financial commentator, his views should be considered as one perspective among many, not absolute truth. With that context in mind, let's explore what Kiyosaki is saying about today's economic climate and the potential market crash ahead. In recent interviews and social media posts, Kiyosaki has been increasingly vocal about what he sees as major warning signs in the current economy. Let's break down his key observations. First, Kiyosaki points to unprecedented levels of global debt. According to the Institute of International Finance, global debt reached an all-time high of $303 trillion in 2023. Kiyosaki believes this debt bubble is unsustainable and will eventually lead to significant economic consequences. Second, he highlights the Federal Reserve's policies over the past decade. The extended period of quantitative easing and low interest rates has, in his view, created artificial asset inflation rather than real economic growth. When these policies inevitably change, he believes we'll see significant market corrections. Third, Kiyosaki frequently discusses what he calls the death of the dollar. He points to increasing de-dollarization efforts by countries like China, Russia, and members of the BRICS nations as evidence that the dollar's global reserve currency status is under threat. Fourth, he notes the growing wealth gap. Economic policies have disproportionately benefited asset owners while wages have stagnated for many workers. This increasing inequality, he suggests, creates systemic instability. Finally, Kiyosaki points to various market metrics that suggest overvaluation, including historically high price-to-earnings ratios in many sectors and signs of speculation in everything from real estate to cryptocurrencies. While some economists might disagree with the severity of Kiyosaki's outlook, many mainstream financial institutions have also warned about potential market corrections. The difference is that Kiyosaki doesn't just see this as a problem. He sees it as an opportunity for those who understand how to position themselves. The core of Kiyosaki's message isn't about predicting exactly when a market crash will happen. It's about understanding why economic downturns can actually create enormous wealth opportunities. The rich don't work for money. They make money work for them, is one of Kiyosaki's most famous quotes. This principle becomes especially powerful during market crashes, and here's why. First, crashes create discounted assets. When markets panic, even valuable assets can be sold at fire sale prices. Those with knowledge, capital, and courage can acquire these assets at significant discounts. Think about those who purchased quality real estate after the 2008 crash. Many saw their investments double or triple in value over the next decade. Second, economic shifts accelerate transfers of wealth. In stable periods, wealth tends to move gradually. During significant economic disruptions, wealth can transfer rapidly from those who are unprepared to those who are positioned correctly. Third, crashes eliminate inefficient businesses and create space for innovation. Many of today's most successful companies were either started during or shortly after economic downturns. Airbnb, Uber, and Square all launched around the 2008 to 2009 financial crisis. These companies identified new opportunities created by changing economic conditions. Fourth, crashes test and reveal what Kiyosaki calls financial education. Those who understand how money works, rather than just following conventional wisdom, can navigate uncertainty more effectively. This is why Kiyosaki emphasizes financial IQ over traditional education. Fifth, market downturns often lead to changes in monetary policy that can benefit certain asset classes. For example, government stimulus and lower interest rates following the 2008 crash and the COVID-19 pandemic created favorable conditions for both real estate and stock market recoveries. However, it's crucial to understand that capitalizing on these opportunities isn't about trying to get rich quick or making reckless speculative moves. It's about having the financial education to understand value, the patience to wait for the right opportunities, and the courage to act when others are fearful. As Warren Buffett famously said, "Be fearful when others are greedy, and greedy when others are fearful." Kiyosaki's perspective aligns with this philosophy, but with his own unique emphasis on understanding the underlying systems. So what exactly does Kiyosaki recommend to prepare for this potential market crash? Based on his books, interviews, and social media posts, here are the key strategies he advocates. 1. Understand the difference between assets and liabilities. Kiyosaki defines assets as things that put money in your pocket, while liabilities take money out. During economic uncertainty, he emphasizes the importance of building assets that generate cash flow, rather than just accumulating things that appear valuable but don't produce income. For example, he distinguishes between a house you live in, which costs you money in mortgage, taxes, and maintenance, and rental properties, which can generate positive monthly cash flow. This doesn't mean you shouldn't own a home, but rather that you should understand the true financial nature of your possessions. 2. Increase your financial education. Kiyosaki consistently emphasizes that traditional education doesn't teach financial literacy. He recommends investing time in understanding how money, debt, taxes, corporations, and investment vehicles actually work. This includes learning about different asset classes, understanding financial statements, studying market cycles, and developing skills to evaluate investments independently rather than relying solely on advisors. 3. Build cash reserves for opportunities. While Kiyosaki is critical of holding too much cash long-term due to inflation concerns, he does advocate building cash reserves to take advantage of opportunities during market downturns. This dry powder allows you to acquire assets when they're undervalued. The key distinction is that this cash isn't being saved for safety. It's being accumulated as ammunition for future strategic investments. 4. Consider hard assets as inflation hedges. Kiyosaki has long been an advocate for hard assets like precious metals and real estate as hedges against currency devaluation. He particularly emphasizes silver, which he sees as undervalued compared to gold. The logic is that in times of significant monetary stimulus and currency creation, hard assets with limited supply may preserve purchasing power better than cash or bonds. 5. Understand debt as a tool, not just a burden. Unlike many financial advisors who recommend avoiding all debt, Kiyosaki distinguishes between what he calls good debt and bad debt. Good debt helps you acquire assets that generate income, while bad debt finances liabilities or consumption. For example, a loan that helps you purchase a cash-flowing rental property could be considered good debt if the property produces more income than the cost of the debt service. 6. Build multiple income streams. Kiyosaki advocates developing income from multiple sources rather than relying solely on a job. These might include business income, investment income, rental income, and royalties. Having diverse income streams can provide greater stability during economic uncertainty and potentially allow you to capitalize on opportunities that others might miss. 7. Consider the tax advantages of business ownership. Kiyosaki frequently discusses how the tax code provides advantages to business owners and investors that aren't available to employees. Understanding and legally utilizing these advantages can significantly impact long-term wealth building. This might include understanding entity structures, legitimate business deductions, and investment incentives built into the tax code. It's important to note that while these strategies align with Kiyosaki's teachings, they aren't one-size-fits-all solutions. Each person's financial situation, risk tolerance, knowledge, and goals are different. What works for one person might not be appropriate for another. While Kiyosaki doesn't claim to know exactly when a market crash will occur, he does point to several indicators that suggest we may be approaching a turning point. First, he watches debt markets closely. Bond yields, credit spreads, and default rates can often signal problems before they appear in stock markets or the broader economy. Recent banking issues and volatility in bond markets have reinforced his concerns. Second, he pays attention to real estate markets, which have shown signs of cooling in some areas after years of rapid appreciation. Housing affordability has reached critical levels in many markets, with the combination of high prices and rising interest rates stretching many buyers to their limits. Third, he monitors inflation and the response of central banks. The Federal Reserve's attempts to fight inflation through interest rate hikes create pressure on debt-dependent businesses and consumers, potentially triggering defaults and economic contraction. Fourth, he observes geopolitical tensions and de-dollarization efforts by various countries. International monetary arrangements that have been stable for decades are showing signs of evolution, which could have significant implications for global markets. Fifth, he looks at wealth concentration and social stability. Growing economic inequality can eventually lead to political responses that dramatically change economic rules and market dynamics. While these indicators don't tell us exactly when a market correction might occur, they do suggest that we may be in what Kiyosaki calls the later stages of a long economic cycle. It's worth noting that Kiyosaki has predicted market crashes before that didn't materialize on the timeline he suggested. This highlights an important principle. The exact timing of market turns is notoriously difficult to predict, even for experienced observers. Rather than trying to time the market perfectly, Kiyosaki advocates being prepared with education, resources, and the right mindset so you can respond effectively whenever economic conditions shift. So what can you, as a viewer, take away from Kiyosaki's perspective? Here are some practical considerations. First, evaluate your personal balance sheet. List all your assets and liabilities, and honestly assess which items are genuinely adding to your financial position and which ones are draining resources. This clarity is the foundation of any sound financial strategy. Second, review your income sources. How dependent are you on a single paycheck? What skills or assets do you have that could generate additional income streams? Even small additional sources of income can provide both financial and psychological benefits during uncertain times. Third, assess your knowledge gaps. Financial education isn't just about reading books. It's about developing practical understanding of different asset classes, taxation, business structures, and investment evaluation. Identify areas where you need to strengthen your knowledge. Fourth, build your network. Kiyosaki often emphasizes the importance of connecting with others who have complementary knowledge and resources. Finding the right partners, mentors, and advisors can significantly expand your capabilities and opportunities. Fifth, start small but start now. Many people become paralyzed waiting for the perfect opportunity. Instead, consider how you can begin applying these principles at your current level, whether that means starting with a small investment, building a side business, or simply reorganizing your finances. Remember that building wealth typically happens gradually through consistent application of sound principles, not through dramatic one-time events. Even if a market crash creates opportunities, your ability to capitalize on them will depend on the foundation you build beforehand. As we wrap up our discussion of Robert Kiyosaki's market crash predictions, it's important to maintain perspective and balance. While economic challenges likely lie ahead, doom and gloom thinking rarely leads to constructive action. Instead, focus on building your knowledge, strengthening your financial position, and developing the discernment to recognize opportunities when they appear. Remember that market cycles are normal and have occurred throughout history. Previous generations have navigated depressions, recessions, inflation, and dramatic policy changes, and many not only survived but thrived by adapting to changing conditions. Whether or not Kiyosaki's specific predictions come true, his core message about financial education and preparation remains valuable. Understanding how money works, developing multiple income streams, and distinguishing between assets and liabilities are principles that serve people well in any economic environment. Thank you for watching this analysis of Robert Kiyosaki's market crash perspectives. If you found value in this video, please hit the like button and subscribe to Oasis of Finance for more content on building financial resilience and opportunity. As always, remember that this video is for educational purposes only and not financial advice. Your specific situation is unique, and any financial decisions should be made based on your own research, goals, and possibly with the help of qualified professionals.